Good afternoon, welcome to the TheoTrade Afternoon video. I'm Blake Young, and today is October 23rd, 2025, and we're going to talk about economic data, government shutdowns, real estate, and maybe industrials. Now I say maybe industrials because we're waiting for reports, we're waiting for information that will allow us to actually trade the market and follow what economic and financials and fundamental views set us up to see. Now you'll notice on this chart, this is the entire week. We should have had a number of key important economic reports this week, last week, the week before, but the government shutdown continues, and so we're not getting our economic reports that are done by the government. The National Association of Realtors does existing home sales. So the existing home sales came in as expected, as forecasted, 4.06 million homes for existing homes being sold. And we may get CPI, we may not. We may get flash manufacturing or services manufacturing, purchasing managers index, we may not. What we're doing is we're going with what information we have when it happens. Now, if we're looking at existing home sales, why did it uptick at all if we're seeing a slowdown? Well, pretty simple. It has to do with interest rates. If we look at the 10-year interest rates, according to the CBO interest rate for the 10-year Treasury notes, you're going to see that we've continually made lower highs, lower lows. We've been pricing in those rate cuts and been pushing the bond prices up and the yields down. Now, today, we've had a pretty significant gap up and close higher. So my question is, did we just put in the bottom? Is 3.95% on the 10-year, and therefore is 5.95, we'll just call it 6% mortgage rate, kind of the bottom of the market? Is that the bottom of the interest rates, and therefore are we reaching a top of what we might expect for expected sales in new and existing home sales? Not sure, but I do think that this tiny little bit of a move higher in existing home sales is because we are seeing the rates drop sub 6% to 3.95%, and so we've dropped about maybe 3/8%. Now, doesn't mean it's going to go all the way back up. It doesn't have anything to do with that. It's simply saying that this is probably what drove existing home sales up. What are we expecting to see in the home builders? That's the question that I have. As you can see in home builders making lower highs, lower lows, and yes, we're bouncing and recovering a little bit off the lows, but we're still in what I would consider a downtrend. Lower highs, lower lows, lower highs, lower lows. So if we're sitting here, then the question is, are we going to return back to 110, or are we going to drop down lower? If we drop down lower, is this another bear flag that we're looking for another 10% drop, and we'd be looking for 95, if not all the way down to 90. Home builders, as we've talked about in the past, they have inventories, and they have inventories that didn't sell while the interest rates were high, and they continued to build. So at this moment, my question is whether or not this is sustainable, and whether this rally is just simply setting up for the continuation of the downtrend, which from a technical perspective would say yes. Now this goes back to the same things we've talked about before. If I'm going to sell into home builders, I certainly could do ITB and short positions, or bearish puts, or long puts, or use XHB for the exact same thing. If I look at the stocks inside of home builders, I want to look for the ones that have the worst financials, the worst fundamentals. And if we're going to look at the stocks inside of ITB or the home builders XHB or ITB, normally we'd be able to find that down here. They've changed a couple of things, so that means we have to click into this link and go directly to the iShares page. If we go here, we're going to scroll down and we're going to go to holdings, and we're going to look at the stocks inside of this and say, I want to look at DR Horton, Lennar, Pulte Homes, NVR, Toll Brothers, etc. Now, I really want to focus on the ones at the top because I don't really want to focus on Home Depot, Sherwin-Williams, or Lowe's. I want to focus on the home builders directly. So let's go take a look. And home builders are considered consumer discretionary, but we'll take a look at the stocks inside of this and the fundamentals around it. So what I'm going to do is I'm just going to run a quick scan of stocks over the price of $25. And, we want to have generally about 1 million shares. I'm going to bring this down because there's a couple I want to pick up here today. Between 500,000 and more, we want some volatility in there. We want some good open interest because we want to trade options on it. But I'm going to look at inventory turnover, quick ratio, and current ratio because these are the ones that are going to be most important. Now, we've talked about fixed coverage charge ratio. Companies that are brick and mortar and are primarily driven by their brick and mortar or location, or have expensive equipment and leases, other things, those are going to be really important to watch for fixed charge coverage ratio. But today I'm going to focus on quick ratio, current ratio, and inventory turnover. What I'm asking is, how quick are they turning over their inventory? How often are they turning over those homes? If we look at current ratio, how much money they have based on what they can normally turn into a cash position of their inventory, and what can they do if they don't sell any more inventory. Now, I've done this with consumer discretionary, so we'll just run the scan really quickly. I'm not really going to go through all of these and looking at these specifically, but we are going to go look at D.R. Horton, and we're going to look at the Lennars and other stocks inside of here, looking at their quick ratio and their fundamentals. So let's go to the Analyze tab, and we're going to go through each one of those. And we'll do this starting with D.R. Horton. And I just want you to see who is going to struggle the most if rates are going to bounce higher. And if we're not getting a big uptick in sales of existing homes, we're probably not getting a big uptick in sales of new homes. As we look down here, there's a couple things we want to look for. Inventory turnover. They turn over the inventory about once a year. That's what that one would mean. If we look over at, that's inventory. Asset turnover is roughly the same because that's their primary business. If we look at their current ratio, their assets that can turn into cash in a year, their short-term assets, versus their liabilities for the year, they have enough to pay for all their debt 6 times over. But if you take the inventory out and say you can't sell a single home, whether the economy is slowing down, whether the government shutdown continues, whether we're talking about other economic crises that will mean that people will not be borrowing and not be buying homes, that quick ratio is saying, what if you sold no inventory? They can make it about half a year. 0.55 would be just over half of a year. So D.R. Horton, it's okay. They don't have to sell any inventory. They can go 6 months without borrowing anything else, without selling anything else. They are fine. Now, if we take a look at some of these others inside this industry, and we'll just go down the list really fast. Lennar, scroll down. We're looking for the worst. Lennar's got the best. It's got 4.68. They don't have to sell any inventory, and based off the current assets, they are going to get paid, or they have enough to pay their bills 4 times over. If they did sell inventory, sold their homes, they can do it 12 times over. And it's also good to know that they are turning over their inventory at 1.59, so they're turning it over better than once a year. They're selling every house in less than a year by having that be a bigger number than 1. Tells you that they're selling it more than once a year. Pulte Homes looks very similar to D.R. Horton's. You can see that we have the number of about 0.5 for the quick ratio, so roughly half a year, and almost the same inventory turnover. It's taking them about 1 year to build a house and turn over the inventory based off cost of goods sold and the average cost of their cost of goods sold, what they're doing there, and a current ratio of 6. So Pulte is about the same as D.R. Horton. Lennar is doing great. Let's take a little closer look at a couple of others. NVR is up there with Lennar, so it's doing great. It's turning their inventory over 3.6 times. So they're doing very good, and they're turning their inventory over about every 4 months, and they have a quick ratio above 2. Now, those are our best ones. What about KBH? What about Toll Brothers? If we look at KBH, scrolling down, you can see they're 0.55, little lower of the inventory turnover, so very similar to D.R. Horton and Pulte, but a little bit worse on that one, a little bit worse on the inventory turnover. This one starts to become interesting, but when we look at Toll Brothers and we scroll down and we look at their inventories and we look over at their data, this is the worst turnover rate. And we also are getting a 0.34 on the quick ratio. So they have inventory they have to sell, otherwise they can't make it more than about 4 months. Yes, their current ratio is good, but again, that's inferring they have to sell inventory. If rates bounce, move higher. If there's more catastrophe in the housing market, if we already see the existing home sales barely moved by 1%, and that was what was expected with the lower rates, then this is probably a sign that this is the stock that we want to sell. We want to look for bearishness in a company like Toll Brothers and looking for the best trade that we can get in playing options or leverage against it. From a charting perspective, it looks very much like the others. We made lower highs, lower lows, lower highs. This is potentially a lower high. Right here, it has not really filled the gap completely, but is still making lower highs and lower lows. Another continuation lower could be a move from 144 down to 126. We'll call that about $18. If we break through the lows, $18 from that price would bring you down to about 116. 116 brings you all the way back down to this gap on their previous earnings. And we may see that directional move kick in before earnings, and might even see it worse on earnings. So there could be even a bigger drop than that. But I'm looking at about 15% drop in Toll Brothers. If I look at the options on this, are the options cheap or expensive? You might think that they're going to be expensive because we're creating this downtrend. Well, you'd be surprised, because we look at the Toll Brothers options, they're 20 percentile here. We only have monthly options, but the volatility is in the bottom 1/5. This means we really can get away with just buying a put. And I would be looking at buying a put for some time, getting it past the earnings, getting into the next year, and even going out into January or March. If we look out to January, we could buy a put in the money at a delta near 70. We'll go with this 66, and it would be $17.40. The time decay of that trade, the extrinsic value, is $3.93 on something that's about 3 months. So can I get at least $3.93? Can I get more than $3.93 against an option in November and turn this into a directional, leveraged, non-time decay trade? Because if I can sell a premium down here, we're going to buy the 66 delta, a $150 strike, and I'm going to try to collect at almost $4 or more by selling an out-of-the-money option here at 135. Now we could go lower. This is the absolute edge of what I want to sell, but it'll work for what we're trying to do. If I sold that and price stays where it's at, I'm going to collect 420, collect 420, collect 420. And so if I do that, I will almost pay for this entire trade by the time we get to January. I'll have a $4 trade and I'll have a $15 spread. If it moves lower, we could continue to roll it down for November into December, from December into January, collecting that $4, $4.15, $4.20, while actually moving this to a wider and wider spread. So it still could end up being about a $4 spread by the time it gets to January in a vertical with no time decay. We've paid for all the time decay that we paid for on the 150 put. We're now collecting premium against time decay, and it could be a $4 cost for a $20 spread if it can reach that target or more. So I do like this as a diagonal on Toll Brothers. And we could absolutely do the same thing with Sherwin-Williams and Home Depot and others that are tangential to the home building process. But I want to come back here and say we are talking about potential opportunities in industrials. Industrials have been able to hold all the way up here, up near the top. The longer this closure happens, industrials do contract work with the government. As long as this closure still happens, there's a potential that we've maybe put at the top in industrials. So I am watching for the data to come out in manufacturing. I'm watching for how long this government shutdown goes to determine whether or not we're going to get an opportunity to sell call premium on specific stocks in industrials. And that's probably what we'll end up talking about next week or whenever we finally see the data come out. But I am getting ready to fade industrials as we've not been able to get through the highs and we're still dealing with the government shutdown. So that's why I said maybe industrials, but primarily we want to focus on home builders. And I'm just looking to fade home builders, continue this downtrend, but I want to sell the one or buy puts on the one that is the worst situation as far as their asset and debt management and their need to sell inventory. If the economy slows anymore, you will see falling home sales, whether new or existing, because consumers won't be spending more. So that is going to do it for me today. So as we're going through, that'll take care of what we're talking about. And we will talk more about industrials in the weeks to come. Thank you for watching. Join me tomorrow morning in the 10% Club for those in there. Otherwise, I will see you later on in the afternoon to talk about long-term trades in the markets.